In this video, I want to talk to you about the political risk insurance in the context of a project finance transaction. Okay, so in my kind of very idealistic kind of point of view of the world, I wish this product didn't exist at all, But however, that's a risk that, we need to deal when it comes to developing and emerging countries. I don't even think that nowadays, with the world that we are facing here now in 2021, we can talk about developed countries and all these terms and barriers that we put. Because when it comes to the context of Brexit and what happens to the US, I don't know whether in terms of the riskiness and especially COVID, when it comes to risk, whether we can separate, what is developing and all this kind of concept. However, let all this behind. That's a reality that we need to face. When you are investing in an emerging, developing countries, there are some risks that as a private sector, you're not able to handle. And the project finance, everything is about allocating risk. Who can handle specific risk better than the other parties? So that's all we are juggling with when it comes to project finance transaction and how to deal with risk. And one of the risks is, of course, the political risks, right? So that's all about the wars, violence, terrorism, currency inconvertibility, and all that comes under political risk insurance. And there are some insurance companies and some institutions that, of course, they provide such an insurance that you can buy. And once you buy that insurance, of course, there's a cost to it. And that cost, you need to incorporate that into your business model and into your financial model. And it's cost that needs to be kind of paid by someone. So if you're talking about electricity project, so eventually that cost, that premium that you're paying for this insurance, it's going to be incorporated in your financial model. And that financial model is mainly used to kind of come up with a tariff, right? At the beginning in the appraisal stage. So basically it's the economy that is paying for that insurance most of the time. So these are all the things that we need to consider when we are talking about the political risk insurance, but it's a reality that we need to deal with. So my aim here in this session is just to talk to you about this political risk insurance. And if you're just starting to build a financial model and you're working in an emerging country and a developing country, you might want to consider this political risk insurance premium in your financial model. So the first thing that we're going to discuss about what is political risk insurance. Okay, so as you know, the whole effort that we put throughout the appraisal stage is to come up with a base case for the financial model. That's the most likely case that will happen. However, since we don't have any visibility about the future, we have to also identify all the type of risk, commercial risk, political risk, economic risk, whatever risk, we identify them and we try to allocate them to different parties so that we can manage the future and anything unexpected events that happens. In the previous video that we talked about contingency provision, and the previous one we talked about the debt service reserve account. It's all about dealing with the risk related to the project. The other one is the political risk. So one of the risk factors that comes into the picture are the political risks, that are risks that are beyond the control of the equity investor or the banks. Okay, so these are, as I said, things like the terrorism or the political violence, wars, or like government nationalization and things like that. So when it comes to that, private sector needs to kind of buy some insurance, some kind of products that can protect against this kind of events. It might happen. And this is what we call, this product is called the political risk insurance, that you can find it like MIGA under the World Bank is one of the institutions that provides it. And there are also many other insurance companies in Switzerland and Marsh, and there are so many of them, even some of the development agencies like the Asian Development Bank, I don't know, maybe African Development Bank, they mostly provide the partial risk guarantee, but there are some kind of institutions that they provide this kind of product to protect the private investors for such risks. Okay, the next question is who can benefit or who can kind of buy this product? So most of the time, I mean, like anything else, you need to submit an application, whether you're an equity or you're a debt provider for a project in a specific country. You need to submit your application to any of these insurance providers and see whether you get acceptance. And they always have a limit for every project and every country for the amount of insurance that they provide. So it depends whether they have a kind of met the ceiling, the limit that they have for that specific country or not. So however, this product is available to any kind of equity investment or even any kind of debt instruments. I have seen in my experience, I have seen projects in the context of Africa where the investors, the private sector investors, they usually kind of require such a product to kind of secure their equity against these kind of political risks. However, when it comes to debt instruments, that's something you need to, it depends on the institutions that you're approaching for your debt. Most of the development agencies, like the African Development Bank and the Islamic Development Bank, they kind of have some immunity against this risk. So they might not require you to go and get this kind of products. However, that's something that you need to approach the banks and ask if they need or they don't need this kind of products. But when it comes to the private equity, that most probably is something that they would consider when they are investing in an emerging and developing country. Okay, so the next question is, how much does the PRI coverage cost? So if you look at like the manual for MIGA or for Marsh, you will get some indication. You don't get the exact formula for calculating these premiums. However, you get an idea about the terms that they offer. So most of the time what they tell you is that it can be up to the maturity of 10, 15 years. It can also go up to 20 years. So these are the maturity that you need to consider in your financial model. A parameter calls the maturity for how long you need to pay that premium for, which means that the coverage of the premium. And in terms of the amounts, as I said, there is a ceiling for every project. They kind of have a limited maximum kind of insurance amount that they can cover, the maximum coverage amount. And it's also, they also have they provide you also with like 90% of equity or 95% of debt service can be covered under this policy. So these are the things that you will see in the contract that you will have with your insurance company. But if you're just starting to build a model and you still didn't approach any kind of insurance company and you don't have an idea about the terms that they're going to offer, these are the parameters that you need to introduce in your financial model. You need to introduce a tenor, and you also need to introduce a maximum coverage, which can be up to 90 to 95% of your total equity or your total debt service. Alright, so let's jump into Excel. I'm going to show you a template for calculating the PRI insurance premiums in your financial models. So this is just like a template, just to give you an indication. So one thing that I want you to kind of note here is that there is no formula that fits all when it comes to PRI calculation. I have seen like many ways of calculating the premiums, depending on who you're dealing with, the institution, whether it's MIGA, whether it's OPIC, whether it's Asian Development Bank, whether it's Marsh. They might have a different formulas for calculating the premium. So you need to go to them and approach them and ask for the way that you need to calculate the premium and then reflect it into your financial model. So this is just to give you an indication, and it can be a good start. If you don't have any idea of who you're going to approach, it's just to put something in your financial model as the kind of like the first estimation. It can be a kind of good kind of benchmark for you. But as I said, just be careful, make sure that this is not something that you can just say that that's it, that's the magic formula. I mean, it all depends on who you're dealing with, the country you're dealing with, and the context of the project and everything else. Okay, so let's have a look at the Excel file. So this is just in this Excel file that I'm going to also provide. I'm going to put the template on my Eloquence channel. You can download it for free, of course. So it starts with some timing assumptions and one dedicated sheet to calculate all the flags and counters for the construction operation phase of the project. So now I am reflecting the political risk insurance parameters that I'm including in my financial model. Once you start applying for this kind of insurance premiums, insurance coverage, the institution, they need to kind of do some what they call application process, right? They need to go through application. They will have some investment officers that need to go through application. Maybe there will be some site visits that they need to go to the site and do some kind of appraisal of the project to understand the riskiness of the project to come up with a premium. So all that you need to pay for it, and there is a fee for it. So when you're calculating the fees, you need to consider these fees as well. So there is one fee that you need to consider, which is called the application fee. So I looked through the my previous projects and also on the website for MIGA and OPEC, and they say that it's around $10,000. This is for the application process. Application fee. This seems to be reimbursable in case you're not being kind of selected. And then there is a payment date as when you're supposed to pay for this fee. Usually when you start the application, you need to pay for it, or in the context of the financial model, you can just consider it the financial close. There is also a processing fee that for this example, I put it up to 50,000 euros, $50,000, that you also need to pay it upfront at financial close. So these are the fees that you need to consider as a startup fees, as an upfront fees in your construction budget, right? So make sure that you have you are including this kind of fees in your construction budget. So after we are done with these kind of upfront fees, there are also some fees that you need to consider, but it depends on the instrument. So as I said, when it comes to debt, you need to kind of approach the lenders and then ask them, do you need the political risk insurance coverage? Is it something that you require? And if they say no, we are already covered, we are AFDB, we are Asian Development Bank, we are IMF, I don't know, whatever agency, and we already have some kind of immunity, some have the coverage, so we don't require that. However, we require PRG or whatever. So that's something that you say, okay, I don't need the debts part. However, I need the equity part. So that's why I have these two different set of parameters, one for the debt and one for the equity. So if that doesn't require, I'm just going to put this coverage to 0, and then that's going to deal with the with the debt, and it's going to just ignore debts. Okay. However, if your lenders say that no, we need this PRI coverage in that specific country, then you need to kind of also put a maximum PRI coverage. You need to put a tenor for the debt. So of course it should cover at least up to the debt service, the maturity of the debt, or to some extent of the maturity of the debt. And then there is a pricing for it, right? It's like for here I am assuming 1% per annum. And then the way you calculate it here, what I am modeling is it's a percentage of the outstanding debts. Okay. And also you need to consider that during construction as well, some of the lenders, they might require the coverage during the construction phase, also during the debt service repayment. However, it might be cheaper or more expensive, I don't know, I think it's cheaper during construction. So these are the different parameters that you need to differentiate between construction and operation. The PRI fee might be different. The same thing applies to your equity. Your private sector, when they're bringing some equity into a country that might have this political risk, they require this coverage. So these kind of companies, insurance companies, they most of the time cover up to 90% of the equity drawn. The equity commitment, they cover it. They say that 90% of the amount of equity that you're putting into this project, I'm going to cover for the political risk. Okay, and they're going to give you a maturity, so up to the first 10 years of the operational phase of the project, your equity is covered. Okay, it can be 10, 15, and as I said, in some projects it can go up to 20 years. And there is a fee attached to it. So for the sake of demonstration, I'm putting 1% per annum of the outstanding outstanding equity. Okay, and there is a different premium for construction and operation fee. Okay, so the last thing that I want to discuss with you here is about the discussion that you might have if you are the equity provider, if you're the lenders, regarding the PRI fee. Who's going to pay for the PRI fee? If the PRI fee is to cover the equity, lenders might object that you include it as part of the project cost and in the SPV cost. They might come up with the rationale that this is a coverage for your equity, and as a lenders or as the SPV, we are not obliged to commit to pay that kind of fee. So they might just refuse you to include it in the project cost, and there will be a lot of discussion during the term sheet negotiation with the lenders about, as we said, the most important cash flow statement in a project finance, which is the cash flow waterfall. So these premiums that you have to pay for the PRI, where is it going to stand in the cash flow waterfall? That's a discussion that the lenders and the equity providers will have to have and negotiate, that whether these fees are going to be covered by the SPV or is it going to be payable directly from the equity pocket. Okay, so when you're building your financial model, you need to be careful about that. You might want to kind of provide some flexibility about who's going to pay for the PRI fee, the positioning of the PRI fee in the cash flow waterfall. Okay, so these are everything that I wanted to cover when it comes to PRI. Of course, this is a very kind of a technical, a kind of financial subject and a legal subject as well. And if you have any kind of things that you want to add to this topic, please feel free to add in the comment section. Let's have a discussion about it and what you think about it, what has been your experience in the project that you have been involved when it comes to PRI, whether you think that it's a kind of useful product or not, whether it's overpriced or not, whatever comes to your mind, let's have a discussion. And that's it for me for this video, and hopefully I will see you in my next video. Thank you very much and goodbye. If you want to learn how to build better financial models, check out my online course on financial model spreadsheet design at courses.phoenixmode.com.